Welcome back, traders. This is Alpha Market Meridian, the channel where institutional data meets actionable strategy. In the last hour, Bitcoin bulls have lost the line. We are not just testing a generic support level. We are crashing into the glass floor of the $79,788 pivot point, a level computed from the prior session's high, low, and close. Right now, with a 1.8% daily drop tearing through the order book, it feels like catching a falling knife. Most retail traders are panic selling, or worse, panic buying the dip with no plan. But here is where the real profit is made. The data on your screen right now is showing a textbook battleground between an extreme short-term oversold signal and a ferocious bearish momentum. A squeeze or a slaughter is loading, and by the end of this video, you won't just have my bias, you will have 3 distinct trade plans, including the exact trigger price for a high probability reversal and the confirmation price for a catastrophic breakdown. Let's lock in. The immediate conclusion for the intraday session is clear. We are in a bearish trend until proven otherwise. The multi-timeframe analysis screams caution. On the 30-minute chart, the sell signal is dominant, and on the 5-minute chart, the strong buy strength is fading, oscillating between a weak buy and neutral. This is the classic DNA of a dead cat bounce. The pivot point dashboard I am looking at, timestamped 10:51 a.m. on May 8th, is our tactical map. The classic pivot point stands firm at 79,788. This is the critical intraday demarcation line for bulls. Right now, price is oscillating around it at 79,900, which means we are in the failure zone. The first resistance, or a 1, is 79,897. We just briefly spiked above it and got rejected almost instantly. This rejection validates the strength of the sellers. For the bulls to have any chance of relief, they must reclaim this 79,897 level on a 15-minute candle close and hold it. Without that, this is a sell the rip environment. But the real alchemy happens when we zoom into the moving averages. The conflict here is so profound it demands your full attention. Look at the exponential moving averages on the intraday chart. The MA5 is at 79,970, curling down sharply, acting as dynamic resistance. Price is literally below the 5-period average, which tells you the velocity of this move is extreme. However, contrast this with the 50-period simple moving average at 81,124 and the 100-period at 80,668. Price has deviated too far, too fast from these mean values. This is not sustainable, and it's why we have a high probability of a snapback mean reversion rally. This is the bear trap scenario in our title. You have the strong sell signal on the MACD, the MACD line screaming below the signal line with a value of -397.2, diving deeper into negative territory. But look at the stochastic RSI. It's reading 33.4. Not yet fully oversold, but if we drop another $200 to $300, it will hit zero, and that energy will need to combust. This mechanical tension, fast momentum down, rate of change decelerating, is what creates the binary event. Now, let's connect this chart to the news flow, because the charts are merely the shadow of the fundamental reality of today, May 8th, 2026. The thesis is simple. Risk aversion driven by a surging US dollar. I've just covered the DXY and S&P 500 in my prior videos, and the correlation is locking perfectly. The 1-year change on Bitcoin is -16.32%, but look at the broader structure. We have a 52-week high of 126,186, meaning we are 46,000 off the high, a drawdown of nearly 37%. This is not an isolated crypto event. It's a massive repositioning. The ETF flows, which I track daily, are likely to show continued net outflows at the close. Institutions are de-risking. Why? The 52-week range tells you everything. From the low of 60,187 to the high of 126,186, we are gravitating towards a critical psychological mean. The volume today is heavy, 57,731, above the average, confirming distribution. In a risk-off move like this, you need to view Bitcoin not as digital gold, but as a leveraged Nasdaq. The Nikkei 225 is dropping as the yen shows signs of strength, and the euro to US dollar and pound sterling to US dollar are crumbling against the dollar. This is a synchronized, cross-asset liquidation. And the so-called digital gold narrative? Flawed here, because gold is likely also facing pressure from a rising real rate environment, though its safe haven bid is creating a fascinating divergence I'll cover next. For Bitcoin, the dominant driver is the liquidity crunch. Therefore, my 1 to 2 week directional bias remains cautiously bearish, targeting a full retest of the lower Fibonacci S2 support levels, possibly around the $73,229 zone, if the pivot point fails. The event that could invalidate this bearish thesis and spark a massive rally would be a sudden policy pivot signal from the Federal Reserve or a major technology sector surge, but for now, the momentum is definitively with the bears. This is where we transition from passive analyst to active sniper. I promised you 3 strategies, and here they are, designed for different risk profiles. Write these levels down. Strategy 1 is the conservative short. This is for those who agree with the breakdown confirmed thesis. Your trigger is a 5-minute candle close below the critical pivot point, below 79,770. We don't chase the break. We wait for the pullback. After the candle closes below 79,770, wait for a weak retest of 79,778. This is the kiss of the dying pivot. Place your sell limit order right there at 79,778. Your initial stop loss goes just above the 5-period EMA at 79,980. This gives you 202 of risk, a tight logical stop. If the price climbs back above the short-term dynamic resistance, the breakdown is invalidated. Take profit 1 is exactly at the S1 level, 75,957. This gives a risk-to-reward ratio of nearly 1 to 4.5. Take profit 2, the runner, is at the S2 confluence, 79,778. The logic is the Fibonacci and classic S2 align here, creating a magnet for price. The failure condition is simple. If the price does not break $79,770 cleanly but instead forms a double bottom with an oversold stochastic bump, cancel the order. Strategy 2 is the standard mean reversion bounce. This is the high probability play, exploiting the bear trap scenario. We are waiting for the stochastic RSI to drop below 5 and then snap back. This is your first confirmation. The trigger is a bullish divergence on the 1-minute chart. Price makes a lower low under 79,700, but the RSI makes a higher low. This hidden signal is often ignored by the masses who only watch the price action. Your long entry will be at market on the break of a 1-minute inside bar high, but only if it occurs above a 1.79,897. Stop loss is placed at the session low of the RSI divergence candle, around 79,500. Yes, it's a wider stop of 400. Reflecting the volatility of catching a falling knife. Your first target is the explosive move back to the mean, right where the 100-period simple moving average sits, at 80,668. This is a massive, high-probability gap fill. Your second target is the 50-period moving average at 81,124. Once you reach target 1, immediately move your stop loss to break even. This is non-negotiable. You are turning a high-risk scalp into a free trade. Strategy 3 is the aggressive breakout fade. This is for the professional risk takers only. We are fading the momentum. As price smashes through 79,700 and everyone screams capitulation, the true extreme lies just below. Watch the 1-second or tick chart for a volume climax, a massive spike in selling volume that exhausts itself within 5 seconds. Buy this with a market order, anticipating a violent V-shaped reversal. Your stop loss is absolutely surgical, 79,650. A 50-point risk. If it ticks lower, you are wrong instantly. Your target is a retracement straight back to 80,000, a psychological round number that acts like a heat-seeking missile for price. I repeat, this is not a strategy for a funded account's core risk. This is a high-leverage, high-cardio tactical strike solely for those who can afford to lose 100% of this microslice of capital. The math demands you take profit here, not hope for a trend change. Before I summarize, let's talk about professional survival. The risk management bell is ringing right now. Today's Bitcoin volatility demands that you reduce your standard position size by 50%. The average true range, or ATR, on the 14-period reading has spiked from less volatility in some earlier snapshots to high volatility on the last chart of 415.6. That means your standard 1% risk must be recalibrated for a 41-point wider stop. Never, and I mean never, hold a 1-minute scalp through a macroeconomic data release. And remember, the stop loss is not a suggestion. It is the price you pay for the right to trade tomorrow. If you cannot accept hitting that $79,980 exit on the short trade, do not take the trade. Here is your alpha recap. Today has only one kingmaker level. The 79,788 pivot point. A close below it on the 4-hour chart confirms a structural shift towards 75,900. A bounce from here is a technical mirage unless it reclaims $80,668, the 100-period moving average. The narrative is liquidity draining from risk assets into a strengthening dollar. The data has spoken, and what is tomorrow's focus? It's not just about one candle. We are on breakdown watch. If the S&P 500 can't hold its key support, which I will analyze in that video, Bitcoin will take another leg down. We are also watching the Nikkei session open tonight for the first fear contagion signal. Keep your eyes locked on that yen. So tell me, what is your line in the sand right now? Scroll down to the comments and tell me. Are you buying the oversold bounce at this pivot point, or are you shorting this breakdown targeting $75,000? I read them, and I might just take your trade in my next video. If this institutional map helped you see through the noise, hit that like button, subscribe if you haven't already, and ring the bell so you don't miss tomorrow's follow-up. I'll see you on the next play.